Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guest who's returning. Actually, I had him booked earlier, and something happened. We had a cancellation, whatever, and I put him in. I put him in this week, and a couple of weeks ago, a week ago, so. Then we had news of Deutsche Bank hitting all-time lows. And what have been people have been saying here on USA Watchdog? They've been quoting Charles Nenner, saying, "Hey, didn't Charles Nenner say watch out when Deutsche Bank stock hits below $8? That not a problem until it goes below $8 and stays there." Well, Charles Nenner, the renowned cycle, geopolitical and financial cycle expert, is joining us today. Charles Nenner, thanks for joining us today on USAWatchdog.com.
Hey, great to be back.
Well, let's talk about Deutsche Bank. I know you called earlier today in the pre-interview. I said, "Oh, I want to talk about Deutsche Bank." A lot of people have been quoting you about look out below $8. What's going on with Deutsche Bank, who the IMF incidentally has called a few years ago the most systemically dangerous bank in the world? What's going on with Deutsche Bank?
Well, there's a lot going on, but I checked the cycles again. I think we're now around 745, 7.5. So it's below the first downside target. We had at $8. Actually, I think it's €8. Is it the euro or dollars?
In dollars, it's 750 in dollars. So I don't know what it is in euros. Maybe $8 in euros.
Okay. So I see it can hold up till the late July, and then it can go to 6.5, 640. If it breaks below 640, then it could go out of business. So it's a very serious situation. I think all the markets can have a bounce starting in a couple of days into the end of July. So that's why Deutsche Bank might hold up. But if it gets below 640, then the world is in trouble.
That's an amazing straight in your face. I mean, we're talking 640, 740. We're talking a dollar between here and financial doomsday. Is that what you're saying?
Right, but that's it's a small stock, so a dollar is a lot of room.
A dollar's a lot of room, but you think I mean it's got I don't know it's got 30 or 40 trillion. It's hard to tell. There's so much fraud going on. 30 or 40 trillion in derivatives. They're trying to join this with Commerce Bank, also in Germany, also another heavily derivative laden bank. You think if Deutsche Bank does get below 640? We might get a daisy chain of default around the world.
Well, I think it's a very dangerous situation, but I think that they're not the only ones. They just got caught. I think if you will look at the balance sheets very closely of other banks, especially in Europe or Italian banks, you will see a lot of troubling signs over there also. We just have to wait till it's being discovered. So I don't think it's only Deutsche Bank. It's much more.
If you take a look at Deutsche Bank in 640, I want to talk about why do you say it's a very dangerous situation? Explain what the danger is.
Well, I work with cycles and with price targets. The idea is that things don't move at random. So things move at certain time periods, up and down, which we pinpoint. And the theories, and it really works very well for already 30 years. If something goes up or down with a certain momentum, then you know where it stops. It's like going in a subway, you know where the stations are, and between the stations there's nothing there, so it goes from one station to the other. So the next station is 640, and if that breaks, then my thing could be around zero. So then we're in really trouble because it got a downside price target of around zero.
Well, what would happen with let's say everybody stampedes at 640 and they're watching this, and a lot of people do. A lot of people with money watch this, so they're watching you, and they say, "Uh-oh, 640." Would that cause a daisy chain of defaults for other banks because everything's interconnected?
Well, if everybody would watch my analysis and would watch the 640 level, and it would go below that, I think then everybody's going to run for the exits. But usually that's not how it works. I have some influence, but not that much of an influence.
Oh, you may have more influence than you think. But you think if Deutsche Bank goes under, other banks, it's going to signal other banks are in the same crappy trouble as Deutsche Bank.
Yes, if they have to close on the derivatives, who knows which bank is going to lose how much? It's going to be a big problem.
Wow. At that point, could we get a global financial reset? Everybody's been talking. The IMF has been talking about this. Christine Lagarde for years that we could get a financial reset. Other people have been talking about a financial reset. What are they talking about? A debt reset, a derivative reset? What are they talking about?
Well, it could be anything, but definitely the derivative and the debt resets because we're at the end of the debt ceiling. And like I've been saying already for years, if you come from the pretty low GDP of 2.5%, and you come with such a high debt that's outstanding, and then you get into recession or even worse, then the GDP goes below zero, the inflation will go below zero. The trick that, for instance, Roosevelt did when he took he took a lot of debt in the Roosevelt time period, but they only paid back 10 cents on the dollar because of the inflation. Now there's no inflation. There could even be this inflation that I'm still looking for. So then they cannot get out of debt. So it's going to be a big trouble.
When they can't get out of debt, what does that mean to the average guy? When you're saying they can't get out of debt, they can't inflate it away, so they just default on everything?
Well, what you get is you get situations like in Europe, in Greece, Italy, Portugal, Spain, that nobody wants to lend out any money anymore. And although you have a recession or depression, interest rates go through the roof because everybody's afraid to give you a loan, so you have to pay a lot of interest.
And you think we're going to get a cycle? I mean, right now with the bond market, you think the cycle is going to go sky high interest rate? That we're at the bottom of the interest rate curve right now, and in the longer
Well,
term,
last time we talked, I was pretty positive about buying bonds.
Yep.
We could see a little bit more, but after the summer, or let's say the end of July, we're going to have a long-term rise in interest rates for a couple of years.
Oh, where is that going to happen? All over the world?
All over the world. But since I don't think the economy will pick up, and that will not be the reason that the interest rates will go up, so something is going to happen over there, and maybe it's a debt problem.
So you're not forecasting rates to go up to fight inflation. You're going up. You're saying that rates are going to go up because everybody's going to be freaked out and holding on to every penny they have.
Well, you don't know. Maybe the Chinese are getting so upset they're going to dump all the U.S. bonds that they have. They're going to lose money also. But we're in our hands, in their hands. They can break and not break the whole situation on the interest rate market.
The Chinese. Before we move on to China, I know because you made a prediction about that. You said that the problems in the world are going to come from China, Southeast Asia, or the whole area, South China Sea, the whole deal over there, because stocks were rising. You said this a year and a half, a couple of years ago. You said this a while ago. I'll get to that in just a minute. But I want to talk about gold. What happens to gold? Because you do have something in your latest thing about your short-term, mid-term, and long-term analysis of gold. What happens if things go crazy? What happens to gold?
Well, it could go crazy. It could be that it's deflation, which most people don't know, that a lot of bull markets in gold are also in a deflationary period. We're looking for a long-term bull market for a couple of years to come, maybe till 2024. And we're fine-tuning it when to go long, gold stocks and gold. So the idea we have is to be short when the summer starts, in the middle of the summer, the bonds. Go long the gold. If you follow us, then we pinpoint exactly when to do it. And I don't think the weakness in the stock market is going to wait till the usual September, October, November period. I think after July, it already starts to be difficult.
Wow. Why is that? Why do you think that?
Why do I think that? Oh, just based on cycles. I mean, for the rest, I always said I know the same fundamentals other people do. And, it's interesting. Maybe you saw I wrote an article about how cycles worked, and I quoted Professor Schiller, who says he's going to write a book about narratives because he says, I got a Nobel Prize for fundamentals, but I came to the conclusion that narratives are more important for bull and bear markets than fundamentals. So we're slowly getting there, but we're a lot of steps ahead because he doesn't know what the narratives are going to be, and we with the cycles, we know if they're going to be good or bad stories, which is going to influence the market. So you never know in advance what's going to be. It could be a conflict, could be a war, could be deflation, could be Trump, could be anything happening. But in our work, that's not important. What is important is what's going to happen in the market, and why. I don't think I'm better than other people, so I don't try to outsmart why these things happen.
Okay, let's. I want to get back into China now. You said this a while ago, and this is when we were having pretty significant problems in the Middle East. And you were like, yeah, Middle East is a problem, yes, but the big problem's coming from China. If you look at the stocks over there, and the stocks are
Yeah.
rising, defensive stocks and all that, that was about a year and a half, 2 years ago, something like that. A lot, not just a few weeks ago, a long time ago, a while ago. And at the beginning of this interview, in the pre-interview, and I said things have gotten worse. And you kind of shook your head, and I said, they're threatening a rare earth metals embargo. They're threatening to sell our treasuries. They're threatening China. They're saying they're going to end for the long term. They're putting out propaganda all over state-owned media in China, talking about how terrible America is. They're bragging about how much money they have to fight a trade war. They're calling the United States, greedy and arrogant. This ain't going to get settled anytime soon. So back to your cycle, you said the problem would be over in Asia, China, Japan, Taiwan, South China Sea, the whole area over there. What's your cycle now talking about China and the whole area?
No, well, we that's not specific. I do the cycle work and I do the war cycle. So I said, starting in the second decade of a new century, always there's a good chance for big wars. You asked me where it's coming from, and I usually think it comes from places where you don't expect it. But then I looked at the airspace industry and other industries in the southeast area, and they're really so much outperforming. So I said something is going on over there. So my first choice is China and surroundings where we could have a big conflict.
And give us some more on that. Why? What could happen? What do you see?
Well, I don't want to tell you what's going to happen. I don't want to worry people, but everybody can imagine what can happen.
Well, no, you got to say. You can't. Come on now. You got to tell us what do you think can happen. You got to give it to us. That's we're all waiting to. They're expecting me to say, oh, come on, get him to tell us what's going to happen. Come on, what's going to happen? We're all adults here.
No, I don't know what's going to happen.
But you think that we could have a shooting war, though? I mean, they're actually reporting that in media right now that we could have a shooting war, and they're talking about China.
Well, so we discussed then that there are always major wars start in the second decade of the new century, and we talked about that if you only look at the 100-year cycle and you Google every second decade of the new century, if it's 1910 till 1920 is this First World War, 1815, 16 is Napoleon, 1740 was Habsburg's War, and you can go down to the year 400, 500, 600. And white people, I don't know how it works, but every second decade of a new century, there are major wars. So that's what we discussed. There are major wars coming. And it's like what we're discussing is like a stock market that goes down. A cycle says the market goes down. And then every stock has a story why it goes down. IBM because of this reason, General Motors of this reason. So now everywhere in the world there's potential danger, big danger. That's because the war cycles are up, and we'll see if it's going to explode somewhere.
What do you think your next move in the Middle East is going to be? For a while now, you were saying that it wasn't that big of a deal. You were saying that you were directing people's attention to China. Good call. We still have it's gotten worse in China, but it's gotten worse in the Middle East. What are your cycles saying over there?
I don't think it's going to explode in the Middle East. And till now it's right, it didn't explode. It actually became better. Now we've got this conflict a little bit between Trump and Iran. But for the rest, things became better and more quiet. And that's what the cycle did show. So it's always possible someone's going to make a big mistake. But for now, the cycles were correct, and it says it's going to calm down, and it's not going to come from the Middle East.
And how long is your cycle saying that it's not going to come from the Middle East? How long do we have this lull period, do you see?
Well, the danger period is up to 2026. A problem is that the gold can go up for another 5 years. Interest rates will go up. The market can go down. So something's going on with this situation. But although I think the debt problem will bring interest rates up, I still think if there would be a huge conflict, then bonds would go through the roof, would go in the other direction. So that's why I don't see it's going to explode for the moment.
When you say go through the roof, that means rates would go down if we have a big conflict. People would run to safety of bonds. It's in inverse deals for the people out there to understand that. When we have big conflict, people get scared. Rates go down because everybody wants to buy into bonds, and they have to pay less. The opposite happens when they have to try to get capital in. Right? It goes the other way. It goes high. Like when you said, people won't be loaning out money, so rates go up. Right?
Correct.
Yeah, but you think you more than likely rates going to go up either in either one of these scenarios, in hyperinflation or rates go way up, or we get war and rates go way down. Does gold do well in both scenarios or not?
Yeah, if you take the history of the gold of the last 500-600 years, and by the way, I have to mention that deflation for the last 800 years is the norm. We remember in our lifetime, if we talk about inflation, the funny thing is, they continue to talk about inflation for the last 15 years. There's no inflation still, but deflation actually is the norm. 80% of the time, the economy is in deflation. And 50% of the bull markets are in inflationary periods and 50% in deflationary periods. So most people who don't study history of finance think it's only inflationary period, but definitely in deflation when there's nowhere to go because stocks can go down, and if there's a debt crisis, yields will go up, and real estate goes down. So everybody will fly into gold. So that's one of the reasons why in a deflationary crisis, gold does very well.
And what are you betting on? What are you telling people to put their money now? I mean, at one point you said, well, you should go out and buy apartments. The real estate may go down, but you'll end up with the apartments and you'll have an income producing asset.
Yes.
So what are you saying now to say, okay, so I've got, 100,000 or $1 million or whatever. Where should people be putting some of their money? I'm not saying that you're an investment advisor. I'm just saying, what are the areas that people should be looking at?
Well, it depends if you're an investor or not. If you're an investor, you have to watch three things. In a couple of days, we have a short-term low in the market, in the stock market, and it could go up till later in July. And maybe you remember we talked in the early 2018 that every year that ends with a 7 is a major top in the markets, like 2017, 2007-8, 97-98, the Asia crisis, 87, etc. And we still did not take out the high of January just after the year that closed out with a 7. So the beginning of January when I went totally out of the market. Now, it looks like in a couple of days we have one more move up. I think the maximum that I see is 3,070 on the S&P, which is still like 5-6%. And the major cycle top comes after the summer. So that's one thing that you have to take into consideration. The other thing is there is a nice way of playing the short side on the bonds. And of course, you can buy soon. Gold stocks would give you a nice dividend, and just wait for the gold market to take off, which is going to take off. Again, I would like to help people, and if they can look at our cycles on the research, then we can pinpoint exactly when to get in and not. But I think that if you soon, we talk about 1 or 2 months, if you will soon go long gold stocks and take the dividend, you'll be very happy with your investment. And the other thing is, I still think the best thing is to buy small apartments and to rent them out. Real estate is going to take a hit, but for the moment you get a better rate of return than putting your money in T-bills, and the real estate will come back in a couple of years.
So you don't see any I don't know, Armageddon type situation where brokerages go under and they completely, many brokerages go under and they end up like MF Global. You don't see that in your cycle work right now.
Oh no, I see that. Things are very dangerous.
Explain things are very dangerous.
Well, we come to the end of an expansion. It was the longest one, and I always talk about this 250 years of what we call super cycle, starting in the late 1700s, and the Fed was trying with all kinds of tricks to keep the economy going, because they had one depression in the 30s, and they decided we're not going to have another depression. So they go from trick to trick to trick, and they run out of trick. Now we try to wear cheap money and low interest rates, and if the economy is going to turn down, and nobody can tell me, even if you don't do cycle work, that this economy is never going to turn down anymore, we're going to be in major trouble with all the debt outstanding. And I only want to mention the student debt that's unbelievable. That's the next bomb to explode. And under the surface, a lot of things that they're not as good as they look for the moment.
And this is the end of this is the end of the longest bull market in history. Is that coinciding with your 300-year cycle too? So you could get a double whammy, the end of the longest bull market in history in stocks and also the end of your, 300-year cycle?
Well, that's possible, but what you have usually is that if it's time for a recession or worse, and you keep it going for another year or 2 years or 3 years by cheap money, whatever, then because the bottom has to come on time, then the downfall is much worse than if you just let it go in natural ways.
So you think they're making it worse? That whatever we're going to get in the future, it's being amplified and made worse by cheap money and buying debt and all this other crazy stuff they're doing in the background.
Yeah, I think every Fed head, like starting with Greenspan, says, "Not in my lifetime. I keep it going, keep it going. I don't want to ruin my name." And the last one who is going to be taking over cannot do anything anymore because they can't keep it going anymore.
And you think we're close to them can't keeping it going anymore?
Well, I see a problem because I don't know what they're doing. I don't agree with Trump is saying about the Federal Reserve, but there is no inflation. I don't know where they get all this situation from, and I think they're still based it on things that they know. Now, what I'm worried about is that even the Fed says we go from number to number. That means it's from months to months, and I go from year to year. So I think I mentioned that before. Should I come to the conclusion that the Fed doesn't have my cycle work and they don't know what the inflation is going to be next year because they have to wait from months to months? That's very worrisome.
When you say that you don't agree with, when you say about, so I'm still back up to inflation. Some people say, well, according to John Williams, inflation's at 9 or 10% if you did it the way it was done in 1980. But you're not talking about that kind of inflation. You're talking about inflation in bonds, aren't you? Explain what your definition, because people are going to be watching this going, wow, there's inflation at my house. The groceries are more expensive, gasoline's going up, tuition is higher, taxes is higher. People will say that. What's your definition of inflation? What are you talking about when you say there's no inflation?
A big part of the work is the CRB index, which is at the lows, and it could break down even. So if that breaks down, then soon crude oil will break down. I mean, don't get me wrong. I think crude is up going now to 67, 68 before it breaks down. Natural gas is already in a bear market, and these are temporary things because there was some wage growth. So prices go up a little bit, but it's temporary. But on a big scale, I don't see where the inflation is coming from.
On the larger, you're talking about long term, not this little square, right? You're talking about years, decades, stuff like that. You're talking about a big chart.
Correct.
That's what you're talking about. Okay, I just want people to explain so they wouldn't go all kind of nutty. And you think that we are? Tell me about the end of this 300-year cycle that we're close to, right? What happens at the end of this 300-year cycle that we're almost in or approaching?
Well, how do you get such a long cycle? Let's start this with the 1929. Okay, so we had a big crash, and let's say you start a small business, and then you don't expand because you don't want to take loans, and then the next generation is a little bit less afraid, and it takes some loans, and then in the 70s, 80s, you go into bonds. You don't give out equity anymore, and you go from trick to trick to trick until you used all the tricks to keep the economy going. And especially now that people are getting older and you don't have so many consumers anymore, you're going to get in big trouble.
So you're saying that all of a sudden, all this production, all this stuff we're making, all this consumer society is going to consume a lot less.
Right. But what I see is that from 2022 and up, we start another bull market, which means it's not going to be the end of the world.
But rough sailing, rough patches, rough. You got to eat for 3 or 4. You can't not eat for 3 or 4 years. You can't live in a cardboard box for 3 or 4 years. Well, I guess you could. Wouldn't be fun. But you see some big bad mamma jamma dark clouds over the economy in the next few years.
Correct. And then why do I say you have another bull market starting 1922? So people who watch this, if it comes down, will not make mistake.
Not 1922, in 2022, right?
Right, 2022.
Okay,
they will not make the same mistake as after the 2000 crash and 2008 crash, and they sell out at the low, and then they forgot to buy back. So it's not the end of the world, but you have to wait 3 3.5 years until the market goes up again.
So how do people get to this from now and this big? So we're facing a big trough, a big downturn cycle. Is that right? Explain that.
Yes, correct. The problem is that the small investor usually is more afraid to miss 3-4% on the upside and less afraid of missing 40% on the downside. It has always been like that. I worked with Goldman Sachs. I did all the market timing, and then I started my own firm. And even people who are with me for 20 years, they know I will write about the cycles, but they cannot get out because it might go up another 3-4%. And it's human nature. So when I say the market is going up one more time starting in a couple of days, they probably says, well, I'm going to play that also. And if the cycle tops a little bit early, then they're not out in time. So soon you have to be very, very careful.
So you're basically telling people that get out of the stock market now. I mean, don't worry about 3 or 4 or 5% right now. You're saying we're looking at 40% coming up. So don't worry. You're saying that right now. Get out of the market because there's 3 or 4% up, but 40% down. Is that what you're saying?
Let's give it a number. I would say if the Dow, because the numbers are very close, if the Dow Jones sees a good close below 25,000, that's only 800 points, and S&P 2750, then I think we're in big trouble.
It's how much lower would it go?
Sorry?
How much lower would it go from there?
The lower. I'm not going to tell you because again, people are going to be so worried. It's I really in this difficult time go to our research. You get it for a while for free. It will help you through the difficult times. And I like to have it written down black and white what I say, so I can always say this is what I said, that's what I said. So I'm not going to be misunderstood.
Well, you have said in the past on this air that you think ultimately the stock market could go to 5,000 on the down.
Correct.
That's where it could go, to 5,000.
Yeah, but to give you one example, when I said that 3-4 years ago on Bloomberg, they said Charles Nenner says now the Dow Jones goes to 5,000. Then it says, oh, you see, it didn't happen. But that's not what I said in the interview. That was the headline they made out of the interview. It says until 2022. They forgot to mention that. So that's why I'm very careful.
But there could be some real. But you'll say there could be thousands and thousands of points down from here. That's what you're saying.
Correct.
And you're saying that's your point was that people are worried about missing 4 or 5% on the downside, but they ignore they could get hammered 40%. 3 or 4% on the upside, but they could get hammered 40% on the downside. You're warning. Go ahead.
It's interesting. I got big pension funds and big institutions, and I got smaller investors, and they're always one against the other. So when the small investor is very positive, the institutional investor is very, very careful, and you see very closely that they start to be very careful, while the small investor is bullish again.
And you're saying don't be bullish. Protect yourself from the downside.
I would say remember my words when S&P gets above 3,000. And remember what I said after July.
Okay.
It starts risky.
But if somebody said, wow, I'm listening to Charles Nenner right now, honey, I think we should just sell our stocks right now and not worry about the 3 or 4 or 5% we get. Would that be a smart play?
It is smart. But if it goes to 5-6%, then his wife will tell him, you know what, we missed. It's not that people say we miss it. They don't say I could have made it. They usually say I lost 5%, and they get very upset. So that's why I'm very careful telling them exactly to take that 4 or 5% or not.
Okay, but you're saying you got to risk getting the 4 or 5% for what could be a 40, 50, 60. I mean, who knows how much on the downside. We could get into big trouble between now and 2022.
Yeah, but I think you have that 4 or 5%. So remember the 4 or 5%, and then start to be careful.
Okay. All right, Charles, anything you want to say? Any longer-term cycles that you want to tell people about? You said, yeah, I do want to work on some longer-term cycles. What would be the longer-term trends that we're going to be seeing here in the next several years that you see?
For several years, starting after the summer, interest rates will go up. And for longer-term period, gold prices, probably also silver prices, and gold stocks will go up. So it's early, so it's better to get in early than when the enthusiasm is exploding and everybody knows now you have to be in gold. It's always the clever money that is now basing themselves into gold stocks are always early, and they don't mind. as long as they know what the cycle is, and the price is going to be much more higher. Remember, our upside price target is 2,500. Well, now we're just at around 1,270, so going up to 2,500 is a substantial move in gold. And again, there's a nice dividend in gold stocks. So I would say is if you go in gold stocks and you sell some out of the money calls against it, and you take the maybe 3% dividend, you have time and you can just wait till we hit the bottom in gold.
And what about silver? I mean, it's, I don't know, under $15 an ounce. It seems like that's about mining cost. Most silver experts say it's around mining cost, is smelting, mining, the whole deal to put into a coin. Is silver a buy, as much of a buy as gold, or not?
Well, one of the indicators that I think is still a bit early is because silver has to outperform gold usually in the beginning, and it's not outperforming. So that's why it's still a bit early to go long in the gold market. And once silver starts outperforming, then it's time to go into the gold market.
And silver too?
And silver too, yeah.
Okay, all right, good deal. So you're bullish on gold and silver, at least for the next, at least until 2024, 25, whatever.
Correct.
Okay, all right, good deal. Wow, thanks for coming on. I appreciate the whole thing. You worked up something on Deutsche Bank. You're worried about Deutsche Bank, right? I mean, that's a problem.
Yes.
Okay, all right, good deal. It's not my imagination.
It's not isolated. It cannot be that they're isolated. They all have intermediate context. So if they have a problem, other banks are going to have the same problem.
And that's your biggest fear, is that it ain't just Deutsche Bank, it's other banks. You see Deutsche Bank, but other banks are in trouble too. If Deutsche Bank gets in trouble, it means a lot of other banks are going to get into trouble.
Just look at the bank index in Europe, and they're very weak. Something is going on over there.
And I'll take that as a closing statement. You have a newsletter. Of course, people can buy your newsletter. You also give it away for free for a week or two. Is that right?
Weeks, and we have intraday updates. So during the day, we'll write exactly, because I got also hourly cycles.
Okay.
So it sounds very extreme. So we can tell you how many hours the market's going up this day and how far it's going up and how many hours it goes down. So you get it also because it's very helpful for short-term traders intraday to know where the market's going.
And you could put in your email and your address, and you can get what you do for free for a couple of weeks just to try it out.
Yeah, you just say I want to get the research plus the intraday updates.
Okay. Charles Nenner from the Charles Nenner Research Channel Center. CharlesNenner.com is the website, correct? Charles Nenner, Nenner, Charles Nenner. Charles Nenner, thank you so much for joining us today on USAWatchdog.com.
Okay, hope to be back.
You will be.